Ladies and gentlemen, welcome to the Fairfield Financial News Podcast. I'm Andrew Miller, and this is my co-host,
Jonathan Vicenti.
It is May 5th, and let's get right into the market recap.
All right, so it's been a couple weeks, guys. We've been busy with finals and stuff, and unfortunately, as you may have noticed, we are not joined with our other co-host, James Prenanentis. He's taking a much-needed break in beautiful Plainview, Long Island. So, yeah, we'll miss him this week, but, we'll see him again soon. All right, so diving right into the market recap, the Dow Jones Industrial Average closed at 38,676. It increased 1.1% this week, and its year-to-date performance is an increase of 2.6%. The S&P closed at 5,128. It increased 0.5% this week, and its year-to-date performance is an increase of 7.5%. The NASDAQ closed at 16,156. It increased 1.4% this week, and its year-to-date performance is an increase of 7.6%. And the 10-year Treasury yield closed at 4.5%. It decreased 0.2% this week, and its year-to-date performance is an increase of 0.6%. All right, so diving right into some inflationary news. Inflation remains a significant concern in 2024, as recent readings have shown that the back of inflation is not yet broken. Last week, the Federal Reserve held interest rates steady, but indicated that conditions aren't improving quickly enough to support a policy change. Despite my initial expectation of a rate cut, I now anticipate that any cut will come much later this year, depending on the pace of inflation improvement.
So I am not convinced that there will be a rate cut this year. I think there's a lot of expectation of inflationary recovery this year, and seeing as nothing has changed, I don't think the Fed's going to make any big move until we see really strong drop in inflation to where they want it to be. So if we saw no rate cut and even a rate hike this year, I don't expect the Fed to make a rate hike because of how it would impact the market. But just fiscally, it wouldn't surprise me to see something like that rather than rate cuts.
Yeah, I have to agree with you there in the sense that I definitely don't see rate hikes happening this year. But I don't know. I feel like with the way that inflation has been going recently, I don't think it's necessarily impossible to see a rate cut later this year, especially with, I think, the way that, the pace of inflation improvement is going. I think, we've definitely seen this in the past, and I think it's very possible that we have a rate cut later this year. But I could definitely see them, just not making any changes at all. But if anything, I definitely don't see a rate hike coming. So moving on to some labor market dynamics. The labor market has played a dual role for the markets last week. Early week labor cost data fueled concerns of ongoing inflation, while a cooler-than-expected jobs report at the end of the week really soothed these worries, while still exhibiting signs that employment conditions remain pretty supportive for consumers. The economy added 175,000 jobs in April, which is below consensus estimates of 240,000. The unemployment rate edged up to 3.9%, while wage growth rate ticked down to a three-year low of 3.9%, helping to offset concerns from earlier in the week. Moving on to some corporate earnings news, which we'll dive into more later. Most S&P 500 companies have reported first quarter results, and the profit picture remains pretty bright. Despite focuses on the Fed and jobs, earnings have largely beaten expectations, and management commentary has been pretty upbeat, supporting recent upward revisions to 2024 profit forecasts. The positive earnings outlook has provided a buffer against market volatility by a number of factors. So, diving into my take here, I think that despite recent volatility, my market outlook remains cautiously optimistic, I would say. The labor market is expected to soften as we move through 2024, and corporate earnings and Fed policy suggest a potential for growth. The current pause in Fed rate changes, similar to previous instances, doesn't necessarily pose a threat to market performance, and I'd say that even an extended pause could be beneficial for these stocks. All right, so moving on to some stocks that really defined these past couple weeks. First up, we have Tesla. Millie, you want to take this over?
So Tesla missed its earnings per share by about 10% this quarter and missed its revenue by 4%. This revenue fell by 9% this first quarter, and it's the largest annual decline since 2012. The lack of demand is finally catching up for Tesla, as people aren't really wanting electric cars in the same sense as they have in the past. This is finally forcing Tesla to cut prices in order to try and boost their demand, but so far it hasn't worked, as Tesla stock price has fell over 40% this year.
Yeah, well, moving on to some wins regarding Tesla. Tesla achieved a pretty big victory in China, which is its second largest market. Elon Musk won Beijing's tentative approval to roll out Tesla's advanced driver assistance service. The full self-driving feature would help Tesla compete with major Chinese car makers that already provide a higher-level driver assistant feature. This regulatory approval is crucial for Tesla as it seeks to boost demand for its EVs, and their shares surged 15% on Monday. All right, moving on to Starbucks. So, Starbucks CEO is working to revitalize the coffee giant after it reported weaker than expected sales and profits in the latest quarter. Its CEO highlighted issues with long wait times and unavailable menu items, which caused many customers to abandon their app orders. I personally have experience with that, by the way. The company also cut its sales outlook for the second time this year. Starbucks is working to address brand misperceptions related to the Israel-Hamas war, and its shares fell 16% on Wednesday. So this is really coming after a long-predicted consumer pullback, which has been shown to impact a lot of major fast food-style chains such as Starbucks, Pizza Hut, and KFC. They've experienced a lot of shrinking same-store sales. And this trend really highlights the intense competition for a smaller pool of customers as diners become more value conscious in response to higher prices and interest rates. Starbucks has commented on this surprise drop in same-store sales. They've attributed the decline to bad weather and increased competition. The company is making strategic adjustments, including a new global leadership structure and enhanced offerings through its app. Despite launching new products like a lavender-themed drink line, business remains sluggish in April. The consumer pullback reflects a broader industry trend where quick service restaurants are facing higher costs and changing consumer behavior, while some chains like Wingstop and Chipotle have shown real resilience in the face of this. The industry faces challenges as consumers cut back on dining. And yeah, I mean, this industry is really facing challenges as consumers are clearly cutting back on dining out and seeking more affordable options. All right, so moving on to CVS. CVS Health's latest earnings were impacted by higher medical costs among seniors, leading to weaker than expected first quarter results. The company cut its 2024 guidance for the second time. Its expansion of its Aetna Medicare plans coincided with an unexpected rise in seniors' healthcare use and regulatory changes. All right, so moving on to Amazon. Miller, if you want to take this over.
Yeah, so Amazon had great earnings. They beat their earnings per share by about 36%, and they even beat revenue by about 0.5%. So Amazon shares have been up since then because this revenue and earnings were both higher than expected. Amazon's showing increased growth and continued growth despite the fact that there is more competitors in this online commerce platform. Advertising revenue increased by 24% in the first quarter, and this means it's growing faster than both retail and cloud computing. And then Amazon Web Services has also exceeded financial expectations. And this is really big because everyone knows that cloud services and web services are going to be huge in the future as people need to use more database systems and app-like systems for their businesses. So cloud services growing is showing very good potential for future outlook.
All right, moving on to Paramount Global. Paramount has been considering a merger with Skydance Media, but the new offer marks Apollo's second bid for Paramount, and their shares jumped 13% on Thursday. It's also worth noting that Warren Buffett in the latest annual Berkshire Hathaway meeting said that Berkshire Hathaway is selling its entire stake in Paramount Global at a loss. The sale signals a shift in investor sentiment as Berkshire, known for its strategic investments, exits Paramount after previously showing interest in the company. The sale impacted Paramount's stock price negatively, contributing to some of its recent volatility. All right, and finally we have Apple.
So Apple beat its earnings per share by about 1.5%, and then beat its revenue by about 0.33%. This was higher than Wall Street expectations, but overall revenue was down 4%, and iPhone sales fell 10% due to increased competition from other companies like Android and Google. The iPhone maker announced that the board also authorized $110 billion in share repurchases, which is the largest in company history, and it has begun spending less to earn more, with its gross margin being at 46.6% this quarter. Additionally, the CEO did not make any announcement about AI, despite having made in a partnership with Google recently to introduce AI. So that's bringing some uncertainty to the market as people expected AI to become a bigger part of Apple's future plans. So moving on to the rest of the earnings reports for this past 2 weeks, Berkshire Hathaway posted an operating profit which surged 39% to $11.22 billion from the year earlier period. This is only for their wholly owned businesses, so anything they have a share in is not considered in this. And its gain was led by a 185 year-on-year increase in insurance underwriting earnings from 911 million to 2.598 billion. Novo Nordisk in March 2024, they beat their earnings per share by about 9% and beat their revenue by 3%. Net profit increased 28% year over year, reaching 25.4 billion Danish kroner, or about 3.65 billion USD. Their popular weight loss drug, Wegovy, more than doubled, totaling 9.38 billion kroner. So a huge amount of their revenue is coming from this one drug. And unfortunately, they are experiencing competitive pressures in the weight loss treatment market from major companies like Eli Lilly, as well as various other large and small firms attempting to enter this market. Moving on to Shell. Shell had a rough earnings, missing their earnings per share by about 4.2% and missing revenue by almost 18%. Shell CEO called it another quarter of strong performance, so he believes that the market estimates were overzealous and thinks that despite missing estimates, it was still a strong quarter for them. They also announced a $3.5 billion share buyback program to be completed in the next 3 months, and its dividend will not be changing. Next up, MasterCard. They beat their earnings per share by about 2.2% and barely beat revenue by about 0.07%. They surpassed their earnings expectations due to a significant increase in transaction volumes, and more customers and businesses worldwide are opting for digital payments, which is going to help MasterCard in the long run. They also benefited from strategic expansions into new markets and services, including enhanced security features and fintech collaborations, which is just broadening its revenue services and customer bases. Next up, Eli Lilly. This is one of the competitors of Novo Nordisk. They beat their earnings per share by about 3.67%, but missed revenue by about 1.8%. Their first quarter adjusted profit exceeded Wall Street expectations, and it raised its full-year earnings forecast due to the strong sales of its diabetes drug Mounjaro and new weight loss treatment Zepbound. The updated guidance reflects improved production outlooks for all of these drugs, and they seem to be confident in their future performance potential. Next up, we have Exxon. They missed their earnings per share by about 5.7%, but beat revenue by almost 2%. Its stock has dropped due to lower refining margins and a sharp decrease in natural gas prices, and additionally, Exxon is in dispute with Chevron due to Chevron's planned purchase of Hess Corp. Despite this, Chevron still announced that it expects to complete the Hess acquisition in 2024. Next up, Chevron, very closely related to Exxon. They beat their earnings per share by 0.5%, but missed revenue by almost 4%. Profits were above Wall Street estimates, but they were lower than the previous year. Similar to Exxon, the refining business saw reduced margins, and gas sales were slightly affected due to declining natural gas prices. During this quarter, Chevron produced 1.57 million barrels of oil and gas daily in the U.S., and they are still confident that its planned purchase of Hess Corp will be completed in 2024, despite Exxon's dispute. Next up, the biggest company in the world, Microsoft, beat earnings per share by 3.4% and beat its revenue by 1.6%. Their earnings were better than expected for both revenue and earnings, but their revenue forecast for the next year was lower than anticipated. Microsoft's CFO, Amy Hood, projected fourth quarter revenue of $64 billion, which is below what was expected of $64.5 billion. The company is spending more to acquire NVIDIA graphics CPUs, which are crucial for developing and operating artificial intelligence models, which shows their commitment to investing in AI. Next up, Google. They beat their earnings per share by 25.6% and beat revenue by 2.3%. Revenue increased 15% from a year earlier, the fastest rate of growth since early 2022, and the company announced its first dividend and a $70 billion stock buyback. Up next, we have Meta. Meta beat their earnings per share by 8.1% and beat their revenue by 0.6%. They reported strong first quarter results, but its stock dipped due to a weak revenue outlook. The company had previously raised investor expectations after its stock tripled last year and increased another 40% in 2024. And Meta's workforce decreased by 10% from the previous year, now totaling only 69,000 employees. Finally, Visa. Visa beat their earnings per share by 3% and beat revenue by 1.7%. They exceeded analyst expectations, and despite strong performance, Visa stock remains under pressure due to economic uncertainty and fluctuating customer spending habits. Visa continues to expand its payment network globally, but still faces stiff competition from other payment processors and new financial technology firms. So, finally, let's move on to our last segment of the day, buy, sell, hold. First up, I have Google. Google obviously had really good earnings this year, and they are reaching a fastest rate of growth since early 2022. And now they're offering their first dividend and are doing a stock buyback. So do you see this as them showing that they're finally maturing as a company to be able to offer this dividend and a stock buyback? Or do you see it as they're ramping up the other ways to give value despite seeing sort of future shortfalling in the growth department?
I don't know. I'm always hesitant. I think it definitely is showing signs that it's a mature company, and I'm always a little bit hesitant to buy mature companies. I think Google has done a great job really maximizing their revenue streams, and I think they have a great future ahead of them. So I would say that despite them, really showing signs of reaching maturity, I think that I would say it's a good buy.
I mean, I have to agree. I mean, a company like Google is going to dominate the internet space pretty much for years to come. And the fact that it's going to start out paying a dividend and that it realizes that it's finally hit maturity and they know they have maturity. So while they continue to try to grow and find new ways to grow, they're now going to be sort of playing in a field where they can be comfortable staying where they're at and just dominating where they are. And I think that's worth a buy for me.
Exactly. I'd have to agree there.
Up next, we have Amazon. So obviously, Amazon had a good quarter for earnings, beating earnings per share by 35%, which is pretty crazy. And I think that the fact that their advertising revenue is going up so fast, it's showing that they're sort of figuring out how to utilize their different platforms and different services on the customer side to gain revenue on the back end side of advertising. I think that's, for me, it's a buy because they already have such a strong business model with their almost dominance of online retail. But then to be able to capitalize on this advertising revenue, I think it brings them to a new level, honestly. Additionally, like the web services is not going anywhere. They're really a strong player in the web services market. I mean, we took a class, database systems, and we're like seeing how much a database can do for a company, and the fact that they offer one of pretty much 3 services for them shows that they have a ton of potential for growth in the future.
Yeah, I'd have to agree there. I'd say, we're looking at a mature company just like Google. And, I mean, like I said before, I'm always hesitant to buy mature companies. But when it's the case of an Amazon or a Google, you really have to look at more than its maturity. And you have to look more at whether they're doing a good job expanding the revenue streams, which, I said Google's doing a good job. I think Amazon's doing an even better job. So I would say it's a buy. Its earnings and its recent growth has really reflected that. It's shown to be resilient through economic downturns and pandemics and such. So I think there's a bright future for Amazon. I think that we're definitely going to see some more growth. They're definitely not going to slow down on expanding their revenue streams. So yeah, I would say that Amazon, definitely a buy.
And then finally, I have Meta. So Meta, I'm a little bit more skeptical about Meta. I think Meta is going to be a very strong company for the future, but obviously its stock tripled last year and has increased tremendously this year. I mean, and now they're cutting employees, so I don't know if that's because they are figuring out where to trim off to get rid of the extra fat of their company where they don't need to spend money, or if it's because they are seeing decreased revenue, seeing increased expenses, and just have to cut down on who they have and what they're working on. So depending on what they're doing with these dropped employees, I think that changes what I think. But just based on the facts that I have here, I would say it's a hold.
Yeah, I'd have to agree with you there. I definitely feel like Meta, out of these three companies, is the one that I'm most uncertain of. I'm not too educated on it, if I'm being honest, but I mean, I understand that it's a mature company, and I feel that while they have done a good job expanding their business, I mean, they've been killing it with acquisitions this past decade. However, I feel that when you're talking about, mature companies, the big thing that I look at is one, where they stand currently, and two, where they stand in the future in terms of expanding revenue streams. If you can tell that by now about how much I was yapping about that with these other two companies. I don't know. I don't have as much confidence in Meta to expand revenue streams in the way that companies like Google and Amazon have. So I would say, I mean, if anything, I personally would say hold, especially, with its recent growth in the past couple years. I don't know if that's indicative of it being overvalued or not. So I would say it's a hold, but I would definitely not refrain from, I'm definitely not crossing it off the list. I'm definitely going to keep an eye on Meta. I think it has a lot of potential. If it handles itself properly, I could see Meta cementing itself as a mature company that can continually grow in the way that Amazon and Google have. So yeah, I would say a hold, but it's definitely not crossed off the list. All right, guys. Well, I think that's all we have for today's episode. Thank you so much for listening. Moving on to some administrative stuff. So it's the end of the semester for us. Jimmy's already gone home. Miller's going home tomorrow, and I'm going home Wednesday. And yeah, I mean, essentially, we're not going to have access to the podcast studio. So there might be a delay in us posting. We're still currently trying to figure out how to go about it, if we're going to do it over Zoom, if we're going to find the studio that we could all meet at. We've also been talking about potentially doing newsletter-style news over the summer until we get back. But yeah, I mean, we're definitely, exploring our options. Stay up to date with our LinkedIn page to see what we decide. And yeah, thank you so much. This is the end of an era for us, but we'll be back better than ever. All right?
Thank you all for listening. We hope you have a great week and enjoy the rest of your time.
All right. And any students that are going through finals right now, keep at it. Drink your monsters. Study hard. Be nice to your professors. And yeah, make sure you hug your dogs when you get home. They miss you. All right. Fairfield Financial News out.